Your bank doesn't lend you money, it creates it. That sounds impossible, right? Because we've all been taught the same story. You put your savings in a bank. The bank lends it out to someone else. Your money helps buy their house. Their loan becomes your interest. Simple, fair, safe. But here's the truth. That's not what happens. Not at all. In reality, when you take out a loan, the bank isn't handing you money from someone else's account. It's typing new numbers into existence. Money created from nothing. And that trick, hidden behind ledgers and legalese, is the foundation of modern finance. So let's pull back the curtain. Because once you see how money is really made, you'll never look at your bank the same way again. Let's start with the story we're told. A saver puts $1,000 in the bank. The bank keeps some of it safe, let's say $100, and lends out the other $900 to someone else. That person spends it. The money gets deposited in another bank. That bank keeps a little, lends the rest, and so on. It's called fractional reserve banking, and on paper, it looks like money is multiplying. $1,000 becomes $10,000 across the system. Sounds magical. But here's the twist. Banks don't actually wait for you to deposit money before they lend. The sequence is backwards. Loans create deposits, not the other way around. When you sign a loan agreement, the bank just types numbers into your account. Boom, that's money. Which means your mortgage, your student loan, that credit card balance, none of it came from someone else's savings. It was created the moment you went into debt. This flips the story upside down, because it means the real driver of money isn't government printing presses. It's private debt. Every dollar in your pocket exists because somewhere, someone else owes a bank. That's the catch. No debt, no money. If people stopped borrowing tomorrow, the money supply would collapse. That's why banks and governments push loans, mortgages, car payments, credit cards, business debt. Debt isn't just a financial product. It is the system. And that system grows as long as debt grows. But what happens when the debt can't grow anymore? History gives us the answer. In 2008, the global economy nearly collapsed. Why? Because the debt machine broke. Banks had created mountains of loans, mortgages bundled into securities. And when people couldn't pay, the illusion shattered. The money that never really existed? It vanished. Credit froze. Businesses failed. Millions lost homes and jobs. And governments stepped in, printing real money this time, to paper over the hole. But here's the uncomfortable truth. The system never got fixed. It just got bigger. Today, global debt is higher than ever. And the machine keeps running because it has to. So why does the system survive? Because it's insanely profitable. Think about it. A bank doesn't need to work for money. It creates the money it lends, and then collects interest on top. You sign a loan for $100,000. The bank types numbers into your account. That $100,000 didn't exist yesterday, but you're on the hook to repay it, plus interest. For you, it's 30 years of hard work. For them, it's a few keystrokes. That's not lending. That's alchemy. And it's the closest thing to legalized money printing you'll ever see. Now you might think, surely governments wouldn't allow this. But here's the twist. Governments need it. Because this is how they finance themselves too. When a government sells bonds, banks buy them. Where do banks get the money? They create it. New numbers on a screen, exchanged for promises of future taxes. Debt fuels the state. The state protects the banks. It's a partnership that keeps the whole machine alive. And once you see it, you realize this isn't a free market. It's a cartel, with governments and banks on the same side. But of course, someone pays the price. And it's not the banks. It's you. Because every time money is created through debt, someone has to service that debt. Interest payments siphon wealth upward, from workers and families to banks and investors. It's not a bug. It's the design. That's why inequality grows. That's why housing feels impossible. That's why student loans never go away. The money system is built on your obligation and their collection. So here's the question. If money is created as debt, what happens when debts get too big to pay? Do we keep piling it up until the system cracks again? Or do we need a different model? Some economists call for debt jubilees. Some say crypto will replace banks. Others think governments will step in with digital currencies. But whatever happens, one thing is certain. The money in your account isn't really money, it's debt. And as long as the system runs on that trick, you're playing a game where the house always wins. This is Economic Chronicles, where history exposes the present, and the future is written in the lessons we refuse to learn.